G'day traders, I'm Greg McKenna. Welcome to Markets Morning. It's the 29th of October 2018. Just a couple of days away from what could be a very interesting close for global stocks and in that sense for markets more broadly. Of course, October's been a terrible month for stocks. Big falls in global markets, in US markets in particular, the S&P, the Nasdaq. It's all been carnage in many respects. The question, I guess, as we look at the weekly charts today, which we'll do, is was Friday's low enough for this move? Are the bears right? Are the bulls right? It's probably too early just yet to tell. Medium term, it looks like they go lower, but potentially in the very short term, Friday night might have been a low. And a big low it could have been too. We saw that the S&P 500 finished down 1.7%. I'm going to have to change glasses, folks. I've got new ones. One are for reading. The other one is for distance. I can't see the screen as I stand back here to do the video. Sorry about that. There we go. Now I can see that other screen. Not very well, though. I've got to be honest with you. 2658 for a 1.73% fall on the S&P 500. 1.2% down for the Dow, 2.3% down for the Nasdaq 100, looking like it's under pressure and just really close to a weekly break. The Australian market was down. We bounced off that 5950 to 5600 level I talked about on Friday, certainly wrote about. That's important. That's got to hold for us. But again, you know, perhaps we're seeing the start of a base building formation. I'll have to wait and see. The US dollar lost its ground. It had made substantial ground. It had broken out on $CAD. It had broken lower on Euro. It had broken lower on Aussie for a new low. But then bonds started to turn around, to catch a bid. We got the 10-year down at 307. Neil Kashkari from the Fed said, "Hey, it's time to pause." Ed Yardeni went on CNBC and said, "Hey, it's time to pause." The pricing for a December hike has fallen down to 65 point something% from 78 point something% the week before. That's important. Interest rate differentials. Doesn't matter what the Fed's saying. The market wants to believe they're not going to act. I don't think that's true. 3.5% growth with a 4% annualized rate in the consumption sector is strong. And unless we see a sustained fall, like Rich Claret has said, in this weakness in the stock market, then potentially the Fed's just going to keep going. And going for another one, another two, another three, and then we'll be talking about it. Anyway, let's dive straight in. I'm going to kick off with the S&P 500. I'm going to change glasses so I can read that. This is not going to go. I'm going to go back to the old ones. Right, now I can see this again. Right, so what have we got? Not very well, though. We've got, as you can see there, this is the weekly uptrend. So it's only a two-touch. And it's from that December low back in 2015. Remember what happened in 2015? We had that that Chinese yuan, 10% devaluation, induced funkiness in markets. And so I've got a bit of a two-touch trend line just from there. And it comes in here, which coincidentally would roughly, if I can pick that up, would roughly fit with the two-touch trend line from, so what's that? That's 2618, which is that 2619 level I was talking about. Obviously, you know, when you're doing these weekly charts. But that's the level to watch, folks. If we close the month below there, then it's going to look really ugly. For the moment, though, if I go back to the dailies, just quickly, I want to show you something. So, wave 1, 100%. That, back to 50%. That, below there, suggests 138%. That low there, just above the 138%. So 2623 or thereabouts, or was it 28? Where did we close? We closed 58. 2628 was that low. So there is every chance that down here in this 26, let's call it 2615 to 2630 region, is a reasonable place for the market to find support. Double trend line support there. So a break below 2615, things get really ugly. 2550, 2450 maybe, something like that. We'll have to wait and see. I'm going to keep going on stocks because this is what's driving the bus. And in many ways, I'm going to bring. I can't see my Nasdaq chart there. These glasses are not working for me today, folks. Indices. There we go. And as you can see, folks, you know, automatically I've got a template saved. It comes up in the manner that I wish to show you. So what do we got here? We got the weekly, right? So nice and easy. Let's draw some trend lines. So you've got that is there. and that one actually goes across there. And so you've got some weakness here. So what do we got? What am I trying to say? I'm trying to say that the Nasdaq, 1, 2, potentially 3. It looks overcooked on the weeklies, but if I blow that back up, and then we do some Fibos, we'll do a Fibo from there to there. I still think the Nasdaq's got a 65 to 68, 65 to 65.20 to 65.70 kind of look about it. So I'll have to wait and see how that goes. In terms of the Dow, if I can find my Dow chart, haven't got any lines drawn on you for you here, but you can see we've had that break now. It looks like it could retest back towards that, and I guess that's the thing. That's what I'm trying to say. There could be some retesting of these levels. So I guess the key thing though is that on a monthly basis, right? If I have a look at my charts here, if I look at the Nasdaq, then the Nasdaq's broken 2 of the uptrend lines and has a 3rd. So 67.58 is the key. That's why I was getting confused with those numbers for the Nasdaq. For the Dow Jones, it's 23.239, so some substantial distance away. Bearish engulfing candles, no doubt, for the Dow Jones. And for the S&P 500, I've got 26.19 as the top of the old uptrend channel that goes all the way back to the 2009 low at 666. So 2619 is a triple whammy number. If we see a close below 2619, it will get ugly, folks. Anyway, so what does that impact on the local market? Well, the local market, as I said the other day, the reason I said 5590 to 5600, you can see that on the weeklies, right? That's our range from 2017. We spent months in 2017 going nowhere. If we break down through there, if I was to do, just a simple Fibo, I don't even know if it's a decent level. So, you're looking at 5490. If we trade down below sort of 5590, and realistically, you'd be looking at a move at 5277 in that sense. For where the local market might go. But for the moment, while it holds above 55.90. In terms of the DAX, it's just throwing over. You can see, it's been rolling and rolling and rolling. 11,000, where the low was last week, is, you can't actually see it properly, but, we've got this gap where it could go back to, but 11,000 is support at the moment, and then 10,000. I'm still looking, if that's a shoulder, that's a head, that's a shoulder. And that 11,700 roughly is the breakout. 11,700 still the resistance. So if that's head, that's a shoulder, then that projects to 10,000. And 10,000 is, about there. So it does look like there's more pressure. This isn't my best one today. I'm really sorry. I don't know what's going on here. Anyway, let's move on and we'll talk about currencies for a bit. So that's just a nice weekly look at the euro. It still hasn't broken 113. It still hasn't broken 112.80. 112.80 is the Fibonacci protection that I've been looking for. There's naturally, that's a head, that's a shoulder, that's a shoulder. There's a natural proclivity of people to want to preempt that. The market's pretty short euro. It's getting shorter euro. The net total US dollar position is not as long as it was. Have a look at markets morning. I've got that in there. But a break of 112.80 for me still biases me down towards 108. And that's where I think it goes in time, but it hasn't broken yet. If you flip it on its head, I'm talking DXY terms, and remembering that the DXY is a derivative of this other stuff. It's the tail, not the dog. Although some people talk of it as the dog, not the tail. 57% euro. So the DXY goes where the euro, the sterling, and the yen largely go in combination. So to that extent, euro is slipping. The weeklies are suggesting lower, but you've got to break 112.80 first. Then we'll be talking about 108. Until that, we're going to respect that range, and 97 in DXY terms. In dollar yen terms, we've still held below that target. We've rolled over a little bit. It does look like we're going to go and test 110.75, which is the 38.2%. That's just the garden variety retracement. You'll notice in a lot of these markets that the levels are just coming back towards the 38.2. So I think it's reasonable when we look at the big stock market moves, those kind of things, just to say, well, okay, where's your garden variety retracement been? Now, of course, Getting the right 38.2 depends on where you want to draw your top and your bottom from, you know, the full 100% range. But for me, the Trump rally is a good place to start. And if you say, you know, that that low in late 2016 to the recent peak, draw your data on that 38.2%. That to me is the level. In currencies, of course, we don't have that big, strong upswing. We've got a lot more sort of aggressive and muted move. For dollar yen, you know, it looks to me like 38.2% is just reasonable. 110.75. We may even get down to 109, below 110 if stocks keep selling off. But it's reasonable to expect as we get into month's end that we could see a rally. If we don't, that's going to be a big tell. I'm just curious how many people are sitting waiting for the rallies to sell. Now, I've written to myself a rally in the S&P 500, 27.12 to 27.48 is for me at this stage where I'll be happy to sell it. If we have a look at sterling, more Brexit messiness. If you have a look at that, so just think about broad picture terms. You've got to move. There's always that retracement to the 38.2, not always, but often. At some point, a retracement comes. Anyway, 38.2% retracement level. When it fails there, between there and the 50%, sometimes the 61.8, but mostly between the 38 and the 50, then it comes back to the start or finish of the move. And if the at level breaks, then we get a 138 projection. So what do we got? We've got to move back towards 126.60 in train, I think, at the moment. Remember that Fitch, the credit ratings agency, said that they no longer think this is going to be a smooth Brexit. Obviously, that goes in the Sherlock files. But if 126.60 breaks, we're talking about 120. That is just a garden variety Fibbo move. That's all I'm saying. 126.60 is the target at the moment. But if that breaks, all heck could break loose in sterling and the sterling crosses. It's got to break first, though. Aussie. Nice little candle Friday night. You know, down to 70.20, then it bounced back up towards 71. It's at 71 roughly right now. And so, you know, the question is that the low? It might be. It might be. Iron ore's up, copper's holding in, gold's doing well, the budgetary finances look good. The Aussie had fallen too far relative to interest rate differentials. The Aussie had fallen too far relative to the copper price. You know, potentially there is a rally coming here. So I have to wait and see. 72.13, thereabouts, depending on where you draw your lines. Somewhere just south of 72.20 is it would be a breakout. Is it going to happen? There's every chance. There's every chance. It really depends on stocks. If stocks do rally into month's end, so that's the next couple of days, the Aussie's going to go big. So we'll wait and see. But overall, it's still in a downtrend. But if you say, let's, you know, where do you want to start that downtrend from? You know, naturally, that's one big move, realistically. There's been pullbacks, but they haven't been, you know, the super aggressive style, have they? You know, if you draw, you know, one of the things I wrote to myself was something like 74.65 or something like that. There you go. There's 75.46. So I've mixed up my numbers. But just like a straight Fibbo retracement of that is 74.46. So we need to be on the lookout for that, folks. We need to be on the lookout for repricing of the US dollar. Now, I think the market's wrong about the Fed. I think the Fed's going to keep going. But if the market changes its mind and starts to undermine it, well, you know, then we get its foot. We get the US dollar's foot taken off the Aussie. Just something to keep an eye on. Something to keep an eye on. My base case is a continuation of this downtrend. In terms of dollar CAD, we had a false break. Blow it up so you can see. We had a false break and see where it ran into. This is why I love trend lines. This old trend line ran into there. So what have we got now? We've got it. It needs to take out that high, which is 130.93. If it can, we're talking about 133.80. If it can, we'll be talking about a higher dollar sing. If it can, we'll be talking about dollar yuan closer to 7. Now, one of the reasons that we had the big turnaround in the US dollar the other night was not just about bonds, was also about the Chinese coming out and say, hey, you know, 7, don't be silly, or words to that effect. And so that's partly why, you know, we saw these turnarounds. And I'll just show you on the daily so you can get a better sense of it. So that's something to watch there. So 131.60. I said 130.90. 131.60, 131.70 opens up 133.89. But below there, it's still, you know, toing and froing for the US dollar. The Kiwi underperformed on Friday night, which means that my Aussie Kiwi thoughts, as usual, were wrong. I'm as good at Aussie Kiwis as the Wallabies are at rugby, and have been for a long time. So Kiwi had a reversal off its strong but false break. Potentially it's the Aussies' turn to do this, so keep an eye out for that. Now, let's have a look at some commodities. Gold. Weekly still looking good. Still, the MACD still suggests some further strength. But the reality is that this 134 to 140, or 138 is what I've called it, has been a bridge too far so far. If stocks keep falling out, when I do my correlation analysis, in here, in this little thing where is it? Can you see it? There it is. There it is. So I do some correlation analysis, and the key thing that I've said, and I'm going to shut up in a minute, the relationship between the yen, yuan, and risk stocks suggests dollar yuan plus the S&P 500 and Nasdaq are the most important asset combo for markets at present, and that the relationship between gold and those and the Aussie yen and those suggests that to be the case. So if stocks rally, gold will fall. If stocks sell off again, gold will rally. That's pretty straightforward, a relationship for me. And 152 to 160 odd still seems a reasonable chance medium term, but perhaps not yet. Perhaps it needs to reverse. If you're wondering why I'm scratching my nose all the time, it is because my moustache is somehow bothering me. Anyway, where is copper? There we go. Copper. I'll get through this quick. Basically, copper's in a range. Nothing to see here. It is drifting. It does look like it could go lower. If copper breaks $2.70.71, we're going to 255 on my charts based on my weekend screen. WTI held above this inside trend within this overall uptrend. My sense is obviously that a close below there would open things up. Now the low that I was writing about is about, or that I'm still writing about, is 64.48. That still seems to me a reasonable target. A break of there would open up substantial 58 or something like that. For the moment, though, you've got to take out last week's low, which is 65.72, and close below the line to really open up this run that could see you down here at 58 odd. In Brent terms, now, of course, we've got a lot of chat about what's going on in oil, and the Russians have said that there's no need to cut things off. I think the Russians are positioning to actually be the dominant swing producer across the globe. I think that they've been cuddling up to the Saudis in order to get close, to have them think that they're working with them, but to actually become the swing producer of the globe. How else does a middle power that's got nukes, that still wants to be a superpower, exert power? It does exactly that, just like it is with gas into Europe. So that's why I think Novak has been playing these games, and he's doing a great job. Anyway, Brent to me does look like it's got lower levels. I've penciled in $70 at some point, so you can see that we've had this fall. The MACD suggests further losses, and my sense is we will get down to 73 at some point. The Iran sanctions are coming, but we'll see how they play out. Now, last but not least, Bitcoin. Right, so this is weekly Bitcoin. It's been going nowhere for a couple of weeks, really tight range. That ordinarily suggests a break of the triangle higher, should run to 71 to 74, maybe even higher. Hasn't done that yet, but my bias is, while above 5650 to 6,000, the chance of a break grow. So if you drill down, you've really got to drill right down. See how it's got nowhere. Your first inkling that it's going high would be a break of 6,800, or call it 6,850. And then, of course, we've got this high there, where it went all the way up to 74. So, they're the two levels. You can draw a trend line across there, and that's actually 38.2% between those two. So, Bitcoin's not doing much. So I wouldn't be playing there at the moment. There's lots of other things anyway. So that's it from me. It's a huge week. We've got non-farm payrolls at the end. We've got the Bank of Japan. We've got lots of data. Last couple of days of the month are going to be really important for how the monthly charts close for the dollar, for stocks. So keep an eye on that. And then, of course, we've got lots of data and things like that. Brexit news still hitting the airwaves, and lots to talk about this week. I'll shut up. It's almost 20 minutes. Bye for now.